Okay. The Central Bank of Nigeria has imposed a 10 million naira fine on any commercial bank that uses unaccredited check printer or personalizer. Beyond the fine, such checks will be withdrawn from circulation. A repeat violation attracts an even stiffer of 20 million naira penalty, along another withdrawal. Welcome to Business Points, where we extract the Nigerian economy and the government policies. I am Kike Lomo Ukeri. The revised sanction regime issued under the Nigerian Check Standard and the Nigerian Check Printers Accreditation Scheme tightens compliance across the industry. Failure to submit personalized check samples for testing will cost banks 5 million naira. Poor encoding or failure to meet mandatory security and quality standards will attract 10,000 naira fine check. The directive signed by the Director of Banking Service, Amisu Abdullahi, updates the 2019 sanction framework. The Apex Bank says the review reflects current realities in the banking sector and is aimed at strengthening the safety and efficiency of the Nigerian clearing system. This is a clear signal that the regulator is shifting from warning to enforcement. By targeting checks integrity, the CBN is protecting payment system from fraud, counterfeiting, and operational risk. For banks, compliance costs may rise in the short term, but for customers and businesses, however, stronger standards means greater confidence in check transactions and a more secure financial system overall. Foreign capital into Nigeria over the past decades has overwhelmingly flowed into banking and finance, highlighting investors' appetite for liquidity-driven sector and short-term returns. A decade-long analysis of the National Bureau of Statistics capital importation data shows banking lending with $30.5 billion, followed by finance at $16.9 billion, production and manufacturing tagged at $4.82 billion, while telecom, trading, and agriculture accounted for smaller slices of the total inflow. Recent trends underscores the dominance of the financial service. In the third quarter of 2025, bank attracted more than 52% of total capital importation, with Standard Chartered Nigerian leading at $2.11 billion, Stanbic IBTC at $1.78 billion, and Citibank at $561 million. Growth in the sector is being fueled by Nigeria's high monetary policy rate of 27%, boosting return on deposits and investment instruments, as well as credit expansion and sustained foreign inflow. Most foreign capital comes from the UK with $2.93 billion, that is 48.8%, followed by the US $950 million and South Africa $774 million. While portfolio inflow dominates, long-term foreign direct investments remain modest, averaging around 4% of total inflow in 2024 to 2025. However, policy reform, including fuel subsidy removal, FX liberalization, and tax reform, have begun to restore investors' confidence. FDI reached $565.2 million in the first 9 months of 2025, the highest in 5 years. Analysis shows that Nigerian banking sector has become the main gateway for foreign capital, attracting portfolio inflow that boosts short-term liquidity but offer limited long-term economic transformation. Rising FDI suggests reforms are gradually paying off, but sustaining this investment will be key to creating jobs, expanding manufacturing, and driving real GDP growth. Despite a modest rebound, 54% of Nigerian businesses remained unregistered in 2025, highlighting the persistent informality in the country's entrepreneurial landscape. The 2025 State of Entrepreneurial Survey by Faith Foundation shows that only 46% of entrepreneurs now operate formally, up from 42% in 2024. Over the past 5 years, formalization has fluctuated. Unregistered businesses rose from 44% in 2021 to a peak of 58% in 2024, before easing slightly in 2025. The slow recovery reflects growing confidence in regulatory process aided by digital registration platforms from the Corporate Affairs Commission. Yet structural barriers, high cost, limited access to information, and mistrust of public institutions continue to deter small and micro enterprises from formalizing. More registered businesses remain under Corporate Affairs Commission, but diversification is emerging. Registration with SMEDAN rose to 24.7% in 2025, while formal trade group and corporate societies gain popularity, especially among small firms seeking community-based recognition. The data shows a cautious return to business formalization, but informality still dominates Nigerian entrepreneurial ecosystem. Strengthening trust, reducing registration costs, and expanding awareness could unlock broader access to finance, legal protection, and growth opportunity for small businesses. Manufacturers and agricultural operators in Nigeria are now facing sky-high interest rates, with some lenders charging up to 60% according to the latest Central Bank of Nigeria data. While deposit rates remain stable, lending costs are surging, putting severe pressure on productive sector already struggling with high energy bills, currency volatility, and weak consumers' demand. Stanbic IBTC leads with 60% maximum lending rate across agriculture, manufacturing, finance, mining, and other sectors. Other banks are close behind, with EcoBank ceiling hit 48% in administrative services. Polaris Bank charges 47.3% for manufacturing, and FCMB applies 46.1% for agriculture and industrial sectors. Deposit rates remain largely unchanged, averaging around 8.1%, with First Bank offering the highest at 8.25%. Prime leading rates shows mixed trending, but maximum lending ceiling are rising across several institutions, highlighting tighter credit conditions for businesses. Analysis shows that soaring interest rates threatens the growth of Nigerian manufacturing and agricultural sector. While depositors enjoy relatively stability, high lending costs could stifle investment, slow production, and increase the cost of goods. For businesses, assessing affordability credit is becoming increasingly difficult, potential squeezing margin and curbing expansion. Nigerian oil production is slipping, falling short of both budget expectation and OPEC quotas. January 2026 figure from the Nigerian Upstream Petroleum Regulatory Commission shows that, including condensate, at 1.627 million barrels per day, down to 6.3% from 1.737 million barrels per day in January 2025. Month-on-month, output fell 5.4% from December 2025 to 1.544 million barrels per day. Crude oil-only production, excluding condensate, dropped to 1.45 million barrels per day, missing Nigerian OPEC quota of 1.5 million barrels per day. Condensate contributes roughly about 196,000 barrels per day to the total production. The decline comes despite the global oil price hovering above $67 per barrel, slightly above Nigerian's $64.85 benchmark, highlighting production shortfall as the main challenge. The shortfall also puts pressure on 2026 federal budget, which relies on projected 1.84 million barrel per day output, while currency and price assumption are already strained. Nigerian persistent production discuss operational and infrastructural challenge in the oil sector. Even with the strong global price, the shortfall limits revenue, strain the budget, and reduce the country's influence in OPEC. Without ramping up capacity and addressing local disruption, volatility will continue to challenge fiscal stability and economic planning. All right, let's take a quick short break now. We'll be right back. Don't go away. Stay with us. Welcome back. If you're just joining us, it's Business Point on Global Television, where we x-ray the Nigerian economy and the government policies. The Nigerian National Petroleum Company Limited is ramping up gas production by 1.8 billion cubic feet per day in 2026 to meet growing domestic demand. Subsidiaries, NNPC Upstream Investment Management Service, and Nigerian Exploration and Production Limited are expected to contribute 1.496 billion cubic feet per day and 223.6 million standard cubic feet per day, respectively. The expansion supports Nigerian target of supplying 10 billion cubic feet per day by 2027 and 12 billion cubic feet per day by 2030, fueling key sectors including LNG, power generation, industrial parks, and compressed natural gas. The plan also aims to unlock over $60 billion in investment across the oil and gas value chain by 2030. NNPC is adopting a base investment development model, clustering gas assets into 23 high-potential hubs to optimize production and infrastructure. Success hinges on the strong governance, industry alignment, bankable project, competitive fiscal incentives, as well as reform in the power sector to strengthen the gas-to-power value chain. This aggressive expansion positions Nigeria to meet rising domestic and industrial gas demand while attracting significant investment. If executed effectively, the strategy could transform the gas sector, enhance power generation reliability, and reduce reliance on imports, boosting economic growth and energy security. Dangote Group has sealed a $400 million equipment deal with China Construction Machinery to accelerate the expansion of Dangote Petroleum Refinery and Petrochemicals. The refinery output will nearly double from 650,000 barrels per day to 1.4 million barrels per day, aiming to become the world's largest. The deal will also supply advanced machinery to projects across refining, petrochemicals, agriculture, and large-scale infrastructure. Refining expansion will boost propylene production from 900,000 to 2.4 million metric tons per year. Urea capacity in Nigeria will triple from 3 million to 9 million metric tons, while the Ethiopia maintained 3 million metric tons, solidifying Dangote as the world's largest urea producer. Linear alkaline benzene output will rise to 400 metric tons, strengthening Africa's detergent and cleaning industry supply. Additionally, base oil production is also planned. This strategic investment positions Dangote Group as global industrial powerhouse. The infusion of advanced equipment accelerates project execution, expands production capacity, and strengthens regional market dominance. Beyond refining, the move boosts Nigerian industrial output, creates jobs, and cements Dangote's ambition to build a $100 billion enterprise by 2030. The Naira gained ground on Tuesday, closing at 1,337 Naira per dollar in the official market, up from 1,344 Naira on Monday. This marks its strongest official rate since May 29, 2024, when it traded at 1,329.65 Naira. In the parallel market, the currency also strengthened to 1,382.5 Naira per dollar from 1,393.35 a day earlier. The appreciation reflects improved dollar liquidity, calmer investor sentiment, and global geopolitical shifts. Ongoing peace talks between Ukraine and Russia, as well as the diplomatic engagement between the US and Iran, have eased market tension and boosted risk appetite. Meanwhile, investors remain attentive to US monetary policy signals, including potential interest rate cuts. The Central Bank of Nigeria continues to maintain a restrictive monetary policy, holding the MPR at 27% to curb inflation and stabilize the FX market, while adjusting the policy corridor to better manage exchange rate volatility. The Naira recent gain signals a cautious recovery in Nigeria's FX market. Stronger liquidity combined with global stability and investors' confidence support short-term currency stability. Sustained improvement, however, depend on consistent dollar inflow, effective monetary policy, and Nigeria's engagement in global economic and diplomatic development. All right, before we call it a wrap, let's take a quick look at the stock market. The Nigerian equity market ended its recent rally on Tuesday with all share index slipping to 0.47% to 189,362.94, and market capitalization falling to 121.55 trillion naira. Profits taken in banking stocks drove the decline, outweighing gains in consumers' goods counter. The NGX banking index the sharpest losses, down to 3.69%. Major banks fell sharply, with Zenith Bank with minus 10%, UBA with minus 6.56%, Access Holding with minus 4.63%, and GTCO with minus 2.33%. In contrast, the consumer goods sector shows resilience, with BUA Food up to 5.77%, Unilever with plus 3.63%, Nestle with plus 2.24%, and Cadbury with plus 1.47%. Softening the overall market drop, industry and insurance stock also saw mixed performance, while the oil and gas index remained largely flat. Trading activity strengthens, with deal volume up to 34.8% and units traded rising nearly 13%, though total transaction value dipped by 4.4% to 60.19 billion naira. The market pullback highlights the dominance of market stocks in shaping investors' sentiment, while consumers' goods and selective industrial offers pockets of resilience. The sharp correction in Tier 1 bank signals caution. Investors are balancing profit-taking against ongoing opportunities in defensive sectors, suggesting a more selective sector-driven approach, which may dominate the near term. Alright, this is where we'll call it a wrap on Business Points today. Join me again next time on Global Television, channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @Global TV NG. Till I come your way again, I am Kike Lomo Okere. I celebrate you all.